The opportunity to present this paper, very early stage draft with a co-author Li Wenlin from the University of British Columbia. And this is part of a larger research agenda with Li Wen and another co-author to try to understand how Chinese state capitalism is constructed at an institutional level, particularly to understand the role of the state and state-owned or state-linked enterprises in the Chinese economy. Our jumping off point, so we have a prior paper looking at Chinese state-owned groups, and we thought it would be useful to turn our attention to the Chinese corporate bond market, which has gathered a lot of media attention recently, but not actually surprisingly little academic attention. So a kind of jumping off point for the paper is Alan Greenspan's memorable metaphor of a corporate bond market as a spare tire, and particularly for bank-oriented financial systems in developing economies. Corporate bond market can play a very important role as a supplemental financing channel for enterprises that don't have access to bank finance to spread risk and to help firms recover from financial crises. But of course, it's difficult to create a bond market, particularly for developing economies. The bond market rests on a pretty robust institutional infrastructure, such as sophisticated credit rating agencies, liquid market for trading debt, robust legal protections for bondholders that simply don't exist in most developing economies. What's interesting about China is that the corporate bond market has developed massively in spite of very weak institutional infrastructure of this sort. So China today has the third largest corporate bond market in the world after the US and Japan. Our argument is very simple. We argue that a state-centric network, really with the state at the center of the network, has substituted for formal institutional infrastructure in China, allowing massive growth or promoting massive growth of this market. So the result is a huge but institutionally very fragile market. And we hope if there's a contribution in the paper, it's to lay out the landscape of what turns out to be a very complex market such that it raises questions about or frames questions about the function of this market and some pretty serious policy questions and implications. So here is a graph that shows the rise of the corporate bond market. Now, one of the complexities of this market is that the generic term corporate bond in China actually covers a whole variety of different debt instruments, which I'll talk about in just a minute. But from the chart, you see this is a market that grew from essentially zero a decade ago. So China experimented with the corporate bond market in the early days of its transition. There were a lot of problems. It abandoned it, and it focused on developing the stock market throughout the 1990s. So the corporate bond market only emerges in about 2005, and then you see this dramatic growth, particularly after the financial crisis in 2008. You see this Mount Everest of debt that's created in China. Now, what are the different instruments here? So enterprise bonds are bonds, the initial type, really the only type of corporate bond that existed in China until about 2005. These were issued exclusively by SOEs, so they're called enterprise bonds because they were created at a time when there was no corporate law in China. So there were no corporations. This was all SOE debt. Corporate bonds are what we would think of as a corporate bond. This is a long-term debt instrument issued by a non-financial corporation. Then we have the money market instruments, the bank market instruments, the MTN and commercial paper, and then finally private placement notes, which are issued to sophisticated investors. Now, one of the interesting things and surprising things in doing this research was to discover there's a significant element of regulatory competition at work in this market. I think something we don't typically associate with Chinese state capitalism. So here is the same chart broken down by regulatory jurisdiction. So enterprise bonds are regulated by the NDRC, National Development and Research Commission, which is a legacy of the Central Planned era. So this is China's premier economic planning agency. As I said, the enterprise bonds initially were issued exclusively by SOEs. These bonds have to state the industrial policy that's being promoted with the bond issuance, and the proceeds have to be used to implement that industrial policy. The CSRC is China's securities regulator. It regulates corporate bonds, and at least historically, they have only permitted listed firms to issue corporate bonds. More recently, they've allowed unlisted firms to do so. And then finally, the PBOC, the central bank, which has jurisdiction over the short-term instruments, CP and MTN, and you see just graphically, you see the way that the PBOC has pulled out ahead of the other regulatory agencies in terms of the issuance of instruments under its jurisdiction. This was a conscious policy effort of the PBOC. So if you go back to the statements of the governor of the PBOC, going back to 2005, he's on record as saying we need to develop a true corporate bond market, very much in the spirit of the spare tire that I mentioned before. And there's considerable evidence that both the CSRC and the NDRC responded to the regulatory competition by loosening their issuance standards for the debt under their jurisdiction. I want to come back to this element of regulatory competition later on because I think it has some interesting potential implications for the future of this market. Just a couple of words more about enterprise bonds, because in terms of trying to understand what state capitalism means, these instruments are very interesting. So you see here the issuance exclusively by SOEs, by central SOEs initially, and then you see, particularly after the financial crisis, massive issuance by local SOEs, principally in the form of local government financing vehicles. So these are SPVs set up by the local governments to, in effect, circumvent a national prohibition against the issuance of local government debt. So these are municipal bonds in disguise, sort of with the tacit approval of the central government as a financing channel to pump money into the local government. More recently, the NDRC has allowed private enterprises to issue these enterprise bonds. Again, they have to be used to fulfill industrial policy. This is one of many illustrations in this area of a phenomenon that I wrote about in a different paper with a separate co-author, which is that under Chinese state capitalism, the stark dichotomy we typically draw between a state-owned enterprise and a private enterprise really breaks down, because almost by definition, any large successful enterprise in China is closely related to the state, either through ownership or through personnel connections or other connections to the party state. So here is, turning to the network perspective, what we mean here really is just to look at who the actors are in this market, to look at how they're related to one another, particularly with the state at the center of these relationships, and then to think about the consequences of this network. So this chart shows the various actors in the market. The size of the circles reflects their respective size of the within that market. So, for example, the largest issuers of corporate bonds, again using this generic category, are the local government financing vehicles with about 30% of all bond issues, followed by central SOEs with about 25%, and then local SOEs, et cetera. You see very small issuance respectively by private enterprises in this market. The largest bondholders are trust and funds. Trust is roughly analogous to a hedge fund in China. These are the only financial institutions that are permitted to invest across all asset categories: loans, bonds, and equity. They are typically owned by a local government or by a central SOE. So those are the actors. Very briefly, we spent some time in the paper describing them, and then we talk about the linkages among the actors. Here we find the same kind of linkages among the actors that we found when we looked at state-owned enterprise business groups in China, namely equity ownership, personnel movements, and then membership in party state organs. I'm not going to spend much time on the second two issues. It's in the paper, but we see pretty extensive personnel links between, for example, the financial regulators and the other actors, for example, the credit rating agencies in this, and also the institutions that are heavy investors in bonds. And we also see membership in at least an ostensible SRO in China, which has membership of every actor in this bond market. There is really no true SRO or private organization in China, so this organization has government officials on it. Basically every member is linked to the state. So it's another form of channeling industrial policy and party influence over the actors. I want to spend more time, a little bit more time, on state ownership. So the gray circles now show state ownership of these actors, and so you see that this is a market of by and for state-owned actors in China. So state-owned actors are issuing the bonds, underwriting the bonds, guaranteeing the bonds, rating the bonds, and then investing investing in the bonds. And it's this kind of state centricity that we want to examine and think about the consequences of this. I'm going to just very briefly here, you see how ownership structures risk sharing among issuers and guarantors. Another illustration of this blurry dichotomy between state-owned and private enterprise, you see some private enterprises actually guaranteeing the debt of LGFV, and local enterprises, local SOEs. Here's the career network showing some of the personnel patterns. So I want to spend more time thinking about the consequences of this network and then the potential policy implications. So what are the consequences of this network with the state at the center for the trajectory of this market? There's some interesting parallels between the developmental trajectories of Japan and Korea's corporate bond market in their developmental heydays to other state-led East Asian economies. So for example, the bond market in its early phase really only privileged large firms that were closely connected to the state, firms that benefited most directly from export-oriented industrial policies. As in China, and as I'll talk about in just a minute, we also saw implicit government guarantees of the debt, basically covering all of the debt issued by the corporations. What distinguishes the Chinese case, I think, is the pervasiveness of state ownership of the actors in this system, as well as, and I'll talk about this in a few minutes, the deep interlinkages between the bond market as it developed and the shadow banking system, something that really didn't exist at the time of Japan and Korea's developmental heyday. So in terms of market operation, there's really, I think, some very interesting consequences of state centricity here. One of them is who is benefiting from the development of the corporate bond market in China? The very same actors that are privileged by the banking system, central and local SOEs. This is not a market that is really performing the spare tire function from the standpoint of providing an alternate financing channel for SMEs. Ratings are very skewed and concentrated, skewed toward the high end, so virtually 100% of all onshore Chinese corporate bonds are given investment grade ratings. In some cases where there is an offshore issuance by the same issuer, the international rating agencies rate those below investment grade, so much wider dispersion by the international agencies. And again, this political economy hierarchy shows up in ratings, so 90% of all central SOE debt is given a AAA rating, the highest rating in China. Only 15% of private enterprise debt is given that rating, even though, not surprisingly, private enterprises are more profitable than the central SOEs. Pricing is another, to my mind, rather mystifying consequence of this state centricity. So here, nominal debt yields across instruments, these are all AAA rated instruments, and what you see is that across the board, regardless of debt instrument, central SOEs are paying the lowest yields on their debt. Private enterprises paying the highest yields. Now these are nominal yields. We'd like to have trading data. We can't get historical trading data by ownership of the issuer with this data set. All of the data is from WIND, a database called WIND. We can get recent trading data, though, and interestingly, this same hierarchy appears in recent trading data. So, for example, CP traded over the last 10 days. Central SOEs are paying about 75 basis points, not paying, but trading at about 75 basis points below the debt of private enterprises and about 25 basis points below the debt of local state-owned enterprise. So this hierarchy is maintained even in the secondary market, which I find puzzling, and I hope maybe the commentator can explain to us. One of the other really interesting consequences is the pervasiveness of the no default norm with respect to these debt instruments. Until very recently, regardless of issuer, there was a blanket or very rigid no default norm covering these debt. Obviously, this has begun to break down over the last year or two. We thought it would be useful analytically to try to disaggregate the different motivations for the no default norm. And we've looked at every near default or default episode in China with the exception of the very few recent ones that have taken place. And we see different motivations for rescuing bond issuers in China. One we call too connected connected to fail. This one responds to political risk. So if an issuer is connected to the government, not surprisingly, it is rescued. But interestingly, this norm applies to private enterprises as well. Where a private enterprise is closely connected to the government, there are cases in which it is also rescued. Another motivation is what we call too many to fail. This is where there's sufficient number of corporate bond holders that the government is worried about social unrest occasioned by a default. And so we have some examples in the paper of bonds that particularly are publicly traded where there are several thousand investors, and those cases turn out to be rescued as well. Of course, too big to fail is at least potentially operative as well, although none of the cases that we looked at even came close to jeopardizing the financial system. All of these defaults are relatively small dollar figure amounts. One could imagine this coming into play with respect to the local government debt, which truly could, I think, raise contagion risk in the market. Just very briefly, an illustration of this, two relatively small bond issuances whose issuers defaulted at precisely the same time, August of last summer. In each case, the issuer had a state-owned parent. Company goes into bankruptcy. In the Tianwei case, the parent refuses to rescue the issuer, and the bankruptcy process is ongoing. In the second case, the parent, the SOE parent, decides to rescue the issuer, and the bondholders are paid in full. What distinguishes these two cases? The bonds are held in the Tianwei case by a small number of SOEs, and so it's interesting to see that the bankruptcy process is being used to work out an inter-SOE creditor dispute in China. At least our speculation is that this may be seen as a way of avoiding thorny political problems of resolving inter-SOE creditor disputes. In the case of CNEG, the case where there was a rescue, the bonds were publicly traded and held by several thousand individuals. This seems to be an illustration of the too many to fail no default norm in operation. So turning to policy questions and implications, what is the function? I guess a basic question that's been running through my mind throughout this project, and it's still looming over the project, is what is the function of this market given the state centricity? Is it functioning as a spare tire? It doesn't seem to be, as I said earlier, providing an alternative financing channel for SMEs, at least not directly. This is a market that is privileging the same actors who are privileged by the state-owned banking system. Is it diversifying risk away from the banking system? No, it's magnifying risk because banks are heavy investors in the corporate bonds. What is it doing? Well, it's certainly channeling funds to local governments, and it's also, again, through privileging SOEs, it's providing rents to SOEs and their political backers. Can this transition from a network to a true market? And here I come back to the point about regulatory competition. This is rather ambiguous, I think, the consequence of regulatory competition. On the one hand, you have the People's Bank of China, which is China's outward face to the world in terms of its financial system, with a governor who seems to want to really liberalize the market. So that seems very healthy. On the other hand, the PBOC's jurisdiction is over very short-term debt instruments. So with this explosion of short-term debt under the PBOC's jurisdiction, the maturities of corporate debt in China are coming down very substantially and would seem to subject Chinese firms to kind of Lehman-like shock and inability to roll over the debt. And so I think that the consequence of regulatory competition are somewhat ambiguous. What about the decline of the no default norm? If there is to be a transition to a true market here, the no default norm is going to have to be managed out of existence. Maybe we're seeing some evidence of that with the use of the bankruptcy system with respect to some of these cases, but it's not clear that the bankruptcy law is up to the task. We don't have time to talk about lots of problems. China does have a bankruptcy regime, but it's problematic. It has not been used very widely, and at least my understanding is that the courts really will not take a bankruptcy case unless they get the green light from political authority. So obvious problems with development of the bankruptcy law in managing this no default norm out of existence. And then finally, the shadow banking system. So as I said earlier, the corporate bond network, bond market has developed in tandem with the shadow banking system in China. So on the one hand, the shadow banking system has dramatically increased the demand for corporate bonds because many shadow banking products are invested in corporate bonds. On the other hand, the risks of the credit bond market have been spread across various actors through the shadow banking system. So to give you an example, in a typical case, a central SOE that can issue corporate debt at very low yield will do so. It will take the proceeds and through its financing arm in its SOE conglomerate, it will then on-lend the proceeds to an SME that could not access the bond market. So in this way, risk from the bond market are being spread across the financial system into the corporate sector. And similarly, many of the shadow banking products, which are issued to wealthy Chinese individuals, are invested in corporate bonds. So risk from the corporate bond market are being spread to individual investors, even if they're not directly purchasing corporate bonds. So the state centricity also applies to the shadow banking sector. Most of the shadow banking actors are state-owned or state-linked, and many of the features of state centricity are metastasizing into the shadow banking system. So the no-default norm that I talked about also applies to shadow banking products for the same reason. The actors are state-owned, and the institutional environment isn't robust enough to allow for investor self-help. So you might think about the shadow banking system as a kind of Keynesian response to over-state regulation of the credit of the corporate bond market. But on the other hand, given these deep linkages and the risks that are being spread across these two systems, it would seem that reform of these two systems is complicated by this interlinkage, and that reform is going to have to proceed in tandem. So those are some of the key issues that we see coming out of this project. So thank you very much. Looking forward to commentators' response.
Thanks a lot. It's a great paper, and Curtis did a wonderful job in expressing the complexity of the issues surrounding the bond market in China. I will just quickly summarize my own take. The paper is actually using a very innovative network perspective to examine this major feature of the Chinese corporate bond market. It finds that a key attribute of the market, the state centricity, has incredibly shaped its development trajectory and operation, and channels its future evolutionary path. So this new framework that Curtis and his co-authors have developed really helps frame an inquiry into the challenges of the Chinese financial system and its transition towards a more market-oriented financial system. The paper is very nicely done. It's very comprehensive, very rigorous. A few key observations. Some of those are highlighted by Curtis, but I just want to say for the completeness of the discussion. A well-functioning financial markets in China calls for this spare tire, the development of a corporate bond market. But currently, it's not really serving the function. While such a market seems to exist and skyrocketed in the last decade or so, actually a close examination reveals that there are some troubling facts. First, a large amount of the activities on that so-called corporate bond market actually were local government funding vehicles in disguise. They are actually local or municipal bond market instead of really a corporate bond market. At the same time, of the remaining true corporate bond market, the observation of the authors is that it's actually serving the same so-called privileged firms, largely state-owned enterprises and already publicly listed firms on the stock exchanges, which are already receiving a lot of other forms of financing. So what's the use? The private sector, small, medium-sized enterprises are still finding it very hard to access this corporate bond market. The paper actually draws a lot of comparison between China and other Eastern Asian economies, which have also the mentality of the government playing a very strong role in economic development, particularly Japan and Korea. They find that, well, there seems to be a same pattern. Bonds issues were effectively limited to the largest firms that are already enjoying other close relations with major banks, with the public market, so on and so forth, or in other words, those already established firms, rather than the small, medium-sized private sector innovative firms, which are supposedly the future of economies for places like China. But those firms don't lack other channels to finance. So again, the comment is, what use? The very actors lacking access to other sources of financing, particularly SMEs, they still cannot use the corporate bond market, at least in the early stage of developmental phase in China. Well, I want to think of my comments to this phenomena that the authors pointed out by trying to go back to the so-called pecking order of a more mature market, such as the United States. We all use the United States as some kind of a benchmark. So how is the pecking order in China different from that of a mature market, such as the United States? Here I'm talking about the pecking order, not of firms' decision to issue new capital, but rather on establishing different kinds of instruments. I have the feeling, at least from my own understanding, the typical sequence in a mature market such as the US, well, again, we first go to internally generated capital. And if that's not enough, maybe the founders might try to get in more capital. Could be from the family, from relatives, so on and so forth. And then it probably would be banks, the private debt market. But then firms in China goes to, if possible, public equity market. And then maybe as a last resort, they would go to public debt market or the corporate bond market. And this is the pecking order for most of the Chinese firms that we observe, as the authors also observe. But maybe surprisingly, maybe not. It's also the same pecking order for most of the firms in mature markets, such as the US. In another way, we're saying, first of all, at various stages, maybe we have private equities. We could talk more about that. Interestingly, public debt or corporate bond comes pretty late in the game, even in mature markets, such as the United States, despite the perceived informational disadvantages of equity. We all know that by using equity, firms are signaling to the outside investors that, well, we want to share a piece of the pie with you. That must mean that it has been perceived to be higher value than what we think it actually is. The debt instrument has less of the so-called informational disadvantage or signaling effect. But despite that, large firms in the United States, for example, they first try to establish a public equity market, and then in a lot of cases, much later, will they start issuing public debt. In fact, even to this date, a large number of publicly listed firms in the United States do not even have a corporate bond rating because they don't need to use corporate bond market. They don't use corporate bond market. Why? What's the problem with, with the public bond market, and what's the problem that the Chinese small, medium-sized firms are facing? Well, let's first talk about the firms, SMEs in China. Well, they have high growth potential, but they also have a huge volatility of their cash flows. They tend to have unlimited, insufficient collateral. They also have many other issues, common issues such as disclosure problems, compliance issues, governance issues, the very issues that the participants of this conference are interested in. So for these kind of firms, investors of good quality corporate bond do not like to invest in them. The typical investors of a corporate bond market in mature markets, they don't really want to worry too much about monitoring the information problems or disciplining or incentivizing the managers, unlike the private creditors, such as a bank. So even for mature markets, you see that a lot of money going into what I call the good quality corporate bond market, the investment grade, are investing for long-term at reasonably high-quality credits. These are investors such as the pension funds. So I think that's probably explaining why we tend to see corporate bonds coming later in the game that are more used by firms that are already established on the capital market, that are already starting to trade on their on the stock exchange and so on and so forth. So they have more mature and stable cash flows. These are firms, as Curtis pointed out, that probably already have access to other sources of funding. So perhaps this spare tire, as we call it, is not going to really be the only lifeblood for firms that have the corporate bond market. But does that mean that it's redundant, it's useless? Probably not. Still, introduction of corporate bond financing for even the established firms can probably meaningfully lower the cost of capital, because now you have more competition from different sources of finance. And also, the listed firms now, they have a listed stock price, which would serve the function of providing at least one meaningful information about how the firms are actually doing. These are information that are useful to corporate bond investors. Again, I want to emphasize that typical bond investors are probably what Curtis and his co-author had in mind as the so-called underprivileged investors, the mamas and pops, or the widows and orphans that we say in the US. They don't really have that much of a sharp insights about how firms are doing. So at least, I think corporate bond often comes after public traded shares, at least for the high quality bond market. But that leaves the low quality bond market. What about those? Well, in the US, the so-called junk bond market came in much late in the game. It's a market that's useful for things that we were thinking about. It provides speculative capital. But just by the very same reason, it's more speculative. It also limits the demand of these kind of instruments from the regular bond investors, the moms and pops, the widows and orphans. Those people don't tend to invest in junk grade bonds. So we're saying it's limited scope, but maybe potentially higher expected risk, high expected return. It's coming towards the later stage of the development of the bond market. It's also, in my mind, at the tip of the debt pyramid. You first have a very established market for regular, high-quality investment-grade bond. And then maybe later, you develop your speculative, junk-grade bond market. SMEs would definitely benefit more from this more speculative channel of investment, as do other types of investors. For example, notably, private equity uses the junk bond market for a large amount of capital. Sorry, I don't know why we have this. Apologize. But that said, I want to say that one important creation or a high valuation of the paper is that this incredible framework that the paper has developed. I think it's very valuable in evaluating any other potential funding channels for China. And for similar economies that are growing rapidly, that are still emerging. It's developing very fast. I mentioned private equity. I want to mention a little bit more. Private equity can be a very important source of finance, especially for small, medium-sized firms, because unlike the bond market, it allows investors to participate on the upside if the firms are doing well, because there's no cap. In places like China, there's a tension between the regulators and the capital market participants on the cap of the bond or bank loan borrowing. You cannot go above a certain ceiling, otherwise you're considered loan sharks of some sort. But for early stage entrepreneurship firms, the risk, the volatility of the future outcome is so unpredictable. If you want the investors to take a huge possible loss on the downside, you probably want to give them some participation on the upside. I think in that sense, equity investments, even private equity, would be likely a more suitable source of funding than corporate bonds, at least the kind of mature investment grade corporate bonds with low cost of capital that we were thinking about. And private equity can permeate in the whole life cycle of the firms. I want to skip this next few lines and look at this picture. Starting from the very early stage until the firm's downfall, you can see various sorts of private equity being engaged, being involved. And they are currently being used in China, but not to a sufficient degree. So I think there's a huge hope there. And secondly, I want to mention a few other things. Converting debt to equity, this has been a big thing, a big theme in China. And it's related to what Curtis was talking about, this no default policy. In China, very rarely would a firm that defaulted on its loan be bankrupt or be liquidated. It's largely because the governments, local particularly, want to protect jobs and so-called social stability. So the party does have its own kind of agenda, and it's messing around with economic activities. But at the same time, I think the problem with the federal Chinese financial system is that when the firms do go through a bankruptcy process, the system is not well equipped to handle it. So largely, the firms that are going through this, bankruptcy process, they end up as being, as being liquidated, the so-called Chapter 7 instead of the Chapter 11, the reorganization. As we all know, reorganization preserves most of the value, whereas in a liquidation, a lot of the intangible values goes up in smoke. So I think in that aspect, legal institutional framework needs to be strengthened. They are there, but they are really not carrying out all the functions to allow Chinese firms to be reorganized more easily. And this is one of the things that the Chinese regulators are trying to do. They are forcing those banks that have a large stake in loans in those failing enterprises. And as you correctly pointed out, a large amount of them are state-owned enterprises. They're forcing these investors, the debt investors, to convert their holdings into equity stakes in the business. It's some sort of reorganization, although sometimes reluctantly accepted by the investors. But something along that line, can we study how to do it better? And also another thing that's particularly being mentioned these days, asset securitization, or issue new asset-backed securities, where the assets are the bank's stakes in failing firms, particularly in the distressed case. Again, the hope is that, maybe diversification through trading on these asset-backed securities might allow more appetite of the market to take on these instruments. So there are myriads of receipts. Or everybody seems to have some suggestions about how to reform the financial system. But I think every one of them needs to satisfy the same rigorous scan as proposed by the system introduced in this paper. So let me just quickly conclude. I think the paper itself is extremely insightful and comprehensive. Curtis probably undersold the paper a little bit. I think a large part of the value comes from the framework. I'm not entirely agreeing with the conclusion regarding the regular corporate debt market as the ample solution to the problem for SME financing per se. But the framework proposed in the paper offers valuable evaluation toolkit for any proposal of solving the problems for the financing of SMEs in China and in many other developing economies. The paper, I think, is a must-read for anyone interested in understanding the financial markets in China. Thank you.
Patrick Bolton. Curtis, this is a very interesting paper. I wanted to comment on the point about competition among regulatory agencies and what we saw, this sharp rise in short-term lending that is overseen by PBOC. Mm-hmm. And trying to give a slightly different spin to what you were saying. One is that this is partly due to a macro policy to stimulate the economy, and if you know what happened for example in the fall of last year, part of the response was, well, we're going to make it easier for corporations or whoever wants to borrow, and particularly through that channel. So I have one explanation for why you saw this very rapid increase. Mm-hmm. And then the other, and I thought you might have a view on that, the other explanation could be that part of this is not fully controlled by PBOC, because it's driven by what you refer to as the shadow banking or shadow debt. Let's put it this way: shadow debt market, and particularly with Alibaba, and there's all kinds of online, very speculative, short-term financing going on, and I think that's partly what's included in your plots. And so, you know, that's a very different story from a spare tire. That's just, there's a lot of demand for speculative investment in China. There are not that many outlets. You know, everybody in China worries. They put their money in the bank. You know, they basically just depreciating. They're not getting a fair return. So where do they go? They're going to real estate. But real estate has been, you know, controlled more tightly in recent years. So where do they go, right? They go into this, this segment.
Right.
Rob Jackson. Curtis, I really enjoyed the paper. I want to get you to say a little bit more about something you mentioned briefly in the paper but didn't come up in your talk or the comments, which is the role of Chinese trust companies in the network you describe. You explain in the paper that about 40 cents on the dollar of these Chinese corporate bonds are owned by these trust companies. It looks like, based on the figures that you do present in the paper, that this is at least a $4 trillion asset base that's held in these trust companies, which is an incomprehensible amount of assets. And you say in the paper that there's really no equivalent in sort of U.S. or other markets of these trust companies. But I'm wondering whether there should be. So you say in the paper, look, these trust companies have the only license in China to invest in all asset classes. They take savings from Chinese citizens and deploy them in these asset classes. And the good news, from one perspective, is that they're mostly state-owned. So in the event that there were some kind of failure in the Chinese shadow banking system, in the end it would be the government that would find itself accountable for some of these losses. And I'm wondering if you have thoughts about the relationship between that and the shadow banking conversation in the States, where many have argued recently that one of the problems with sort of money market systems, to give one example, is that it is an unlicensed regime. That's basically regulatory arbitrage that in the end would have to resort to a state guarantee anyway, and in fact in 2008 did resort to a $1 trillion state guarantee. So I'm wondering if you have a thought about whether the Chinese have stumbled into an outcome that, at least from some, based on the financial crisis, at least from some regulatory perspectives, might be desirable, or more likely, I think you would say it's a more complicated story and we should be concerned about that trust system. But you haven't said anything about it today. I'd like to hear more.
My understanding of the history of development of capital markets in Western countries was that bond markets developed first. And so I guess an interesting question is, why was it that equity markets have developed first in China? And does that have something to do with, you know, if you had an explanation for that, what the problems are in terms of the development of a bond market?
Yes, also to carry on with the analogy with the United States of the discussant and of the sir, also the description of the parent-subsidiary relationship and how the state enters versus non-enters into these guaranteeing schemes reminded me of the government bailouts of the investment banking companies that had implicitly guaranteed the special purpose vehicles. And there was also ex ante substantial stake of the government in those vehicles because of the tax breaks that had been granted to those vehicles in the first place. So I wonder more generally whether it's better to have an indirect system like in the United States that may obscure the complexity of the network and the complexity of the debt, of the shadow debt, rather than a more direct one in Chinese economy.
So in the U.S., when we talk about debt, we talk about terms. So we talk about monitoring, covenants, collateral, interest rates, all the stuff that you didn't talk about. So the question is whether could you add them, or what would it mean? For example, does anybody take collateral in these things? Does anybody foreclose? Is there a secondary market in any of these instruments? So it's just a request for a little more detail, which may be beyond the scope of the paper, but it was at such a macro level that you wondered what exactly you mean in China by a bond. I know what I mean in the U.S. or England, but not. So there's a request for a little more detail, actually.
Okay, thank you very much. Great set of comments, very helpful. Let me just start with Alan's point. So some of this is in the paper. None of this debt is secured, basically. The prospectuses are very skimpy on any sort of covenants. There are some, but I don't think anyone thinks they're meaningful because there's no resort to the legal process by the bondholders for this. There is a trading market. Most of it is an interbank market. The corporate bonds, true corporate bonds, what I've called this category, are traded on the stock exchanges. So there is some limited market for trading. On Li Jin's comments, very helpful. And of course, I agree with you that the bond market itself is not going to be the primary channel for financing SMEs. And I think PE is a really interesting area. I'd like to look at PE in China. I think that's another fascinating area to be explored. Several questions have talked about developmental trajectory. To Merritt's question and also to some of the comments of Professor Jin. So, I mean, yes, the bond market typically developed first, but with government bonds, I think. At least that's my understanding in the U.S. and elsewhere. And that's true of China, too. So there was an active government bond market way back in there, going back 20, 25 years in China. Actually, it was the negative impact on the government bond market of this early corporate bond market that caused them to shut it down and to just wait and focus on development of the stock exchange for the ensuing decade. So in that sense, I think China's developmental trajectory is, I agree with you, is pretty much the same. That is, the corporate bond market comes after the government bond market and then the stock market. But I guess what's of concern to me as someone who's thinking about institutional development is that what we've called state centricity seems to be retarding pretty dramatically the development of true institutions to support a bond market. So the bankruptcy regime, the credit rating agencies are pretty clearly not functioning for anyone's true benefit. And so I think that there's been this substitution effect of the state for institutional development, which may account in some way for China's development. But what is the transition? How do you transition out of that? If the state isn't going to recede, I don't see how you'd build the institutions that are necessary to carry forth the next stage of development. So I think that's the principal concern. On the analogies to the U.S., I mean, it's interesting. I haven't really thought about it that much. I mean, yes, there are some analogies to be drawn, but I think, again, the difference is that yes, the U.S. at times the government steps in to rescue a firm in a disaster, et cetera. But we do have, I think it's fair to say, a pretty robust environment. It's got its weaknesses and so on, but we do have a pretty robust environment for economic activity and development. China doesn't yet have that, and so my concern is that the pervasiveness of the state is taking up the space that would otherwise be filled by institutional development. And your point, you suggested that the U.S. was rather opaque in the way the government involves, and it's very direct in China. Actually, I mean, I'll take that as a compliment on the paper. It's actually pretty damn complicated. I mean, it's taken years to figure out how this system is, the basic architecture of this system. There's a lot of corporate boxes and trying to figure out, even at this level, what is the function of this market it's puzzling. So I wouldn't say that the Chinese system is very clear and direct. I think it's actually very, very opaque. What else to be said? I think I'll leave it at that. So, very, very helpful set of comments, and I certainly do want to follow up on the suggestion to try to think about using this framework to analyze other financing channels in China. So, thank you very much.